Anytime I make a credit sale to a customer, there is always a chance that what's going to happen? They're not going to pay me. Either they cannot or they will not pay me what they owe me. So if I'm going to make credit sales, it is inevitable that I'm going to have some accounts I can't collect. The amounts those customers owe me, we're going to call those bad debts or uncollectible accounts or doubtful accounts. We have two ways of accounting for uncollectible accounts. The first method is called the allowance method, and that's what we're going to be talking about. There's another method called the direct write-off method that we're not going to cover. Theoretically, the allowance method is good, the direct write-off method is not, and so we will just cover the allowance method. So let's talk about the allowance method of accounting for my uncollectible receivables. The allowance method is good because it goes along with the matching principle. Let's take a minute and review the matching principle. That was back in chapter 3. The matching principle says we want to match expenses with the revenues they help generate. Match expenses with the revenues they help generate. That's really impacted what we've done all semester long. For example, when I buy supplies, they are an asset to me. They become an expense to me when I do what? Use them up. And that's when they become an expense because that's when they help me generate revenue. So we have revenues recorded in the same period as the expense. How about inventory? When I buy inventory, it is an asset to me, right? When does it become an expense to me? When I sell it, and then it becomes cost of goods sold. Why does it become an expense then? Because that's when it generates revenue. So I'm matching revenues with expenses. The allowance method then is going to give me good matching of revenues and expenses. Now, if you think about it, if I sell to a customer this year in the year 2013, and that customer is not going to pay me, I'm going to have some expense that results. To have good matching, if the revenue is on my books this year, the expense needs to be on my books this year also. However, the problem is when I sell to a customer, do I know whether or not they're going to pay me? No, if I knew that, if I knew they weren't going to pay me, I wouldn't sell to them in the first place, right? So I might make a sale to a customer this year, and I might not find out until next year the fact that they aren't going to pay me. What I would not want to do is to record the revenue on my books this year and the expense on my books next year. For that reason, we're going to have to estimate the amount of my uncollectible accounts. When we use the allowance method, we're going to make a new adjusting entry. So this is simply another entry we add into all of my chapter 3 entries. Here's what it's going to look like. I'm going to debit an account called bad debt expense, and I'm going to credit an account called the allowance for doubtful accounts. Debit bad debt expense and credit the allowance for doubtful accounts. The amount of this entry is going to be an estimated amount. It is not an absolute known factual amount. It is going to be our best estimate, and we're going to talk about how we calculate that later on today. Bad debt expense, what type of an account do you think that is? An expense. It's a plain old expense on the income statement. It has a debit balance. Nothing very new about that. The allowance for doubtful accounts is a contra asset. Have we had a contra asset before? What was it? Accumulated depreciation was a contra asset. Remember that one? What did we do with that contra asset? Well, we subtracted it from the asset on the balance sheet. Allowance for doubtful accounts is a contra account. It's contra to accounts receivable. So it will show right after accounts receivable on the balance sheet, and we will subtract it also. Now, a contra account always has the opposite balance of what it's contra to, right? So assets have a debit balance. A contra asset should have a credit balance. The allowance for doubtful accounts, being a contra asset, should have a credit balance, although we will see sometimes temporarily it may end up with a debit balance. So we'll talk about that actually in the next class before we get to how that could happen. Why don't we just credit accounts receivable? If you think about it, that kind of would make good sense to make it go down because we know we can't collect part of that. Well, to understand that, I need to mention something that we don't cover in this course. We used to have a chapter on this, but we don't talk about it. And it's something called subsidiary ledgers. What does it mean if something is subsidiary to something else? Additional information, secondary to something, supplemental information. There are certain accounts in the general ledger that I need to keep a subsidiary ledger for because I need more detailed information about them. For example, with accounts receivable, I need to know not only in total how much my customers owe me, but I need to know how much each individual customer owes me, don't you think? So I would keep a separate book with a page for each individual customer. Now, at any point in time, I ought to be able to add up what's in the accounts receivable subsidiary ledger, and it should equal accounts receivable in the general ledger. So if I have 5 customers who owe me $10 each, I should look in accounts receivable in the general ledger and see a balance of 50. Now, to make those two stay in balance, every time I post an entry to accounts receivable, I really have to post it twice. Once to accounts receivable in the general ledger, the second time to a customer's page in the subsidiary ledger. Because if I posted it to one and not the other, they wouldn't stay in balance. That's why I can't credit accounts receivable, because I wouldn't know which customer's page to post it to. Remember, this is an estimated amount. It's not like one particular customer won't pay me. So I would not know which customer's page to post it to instead. How does accounts receivable show on the balance sheet? Well, we're going to show it at the total amount, and then we're going to subtract the balance in the allowance for doubtful accounts. Now let's back up to accumulated depreciation. Let's think about how we showed accumulated depreciation on the balance sheet. We showed the truck at its total cost. From that, we subtracted the accumulated depreciation. The cost minus the accumulated depreciation gave me an amount we called what? Book value, or carrying value. Cost minus accumulated depreciation was the book value or carrying value. With accounts receivable, we're going to show it at the total. We're going to subtract the balance in the allowance for doubtful accounts, and that gives me a figure I'll call the net realizable value. Realizable is a fancy word for collectible. Yes, we show all three of these numbers. Let's talk about what that means. That means, number one, my customers owe me $1,000 in total. The second number means I think I'm not going to collect $80. The balance in the allowance for doubtful accounts is what I think I'm not going to collect. So customers owe me $1,000. I think I'm not going to collect $80, which means I think I am going to collect $920. So the net realizable value is the net amount I think I am going to collect. How do we estimate bad debt expense? Well, there are two ways of doing it. One method is basing it upon sales, with the idea being, if my sales this year were double what they were last year, wouldn't you expect my bad debt expense to double also? Doesn't that seem logical? The second way we can do it is based upon something called aging my accounts receivable. The assumption here is that if my year-end balance of accounts receivable was twice what it was last year, wouldn't you expect my uncollectible account to probably double also? And the other assumption built into that one is that the older the receivable is, the less likely I am to get paid. Let's cover the first method though, basing it upon a percent of sales. Percent of sales. We ask ourselves the question, how much of this year's sales do you think we're not going to collect? Now, for your purposes, that's going to be pretty straightforward. They're going to give you a percent, and that's a percent you're going to use. In the real world, the challenge is coming up with that percent. How are you going to do it? You're going to look at your historical experience. You might temper it up or down for the economy. But we're simply going to take this year's net sales and multiply it by the percent, and that's what we're going to make our entry for. The key, and this isn't going to make a lot of sense until I cover the next method, is that you don't care what's already in the allowance for doubtful account. You're trying to estimate how much is uncollectible from this year's sales. Any amounts that are uncollectible from prior year sales, they're already in the allowance account. We don't care about them right now. Let's do an example. What page are we on? 7. My credit sales are $1,000. The allowance account, before we do anything, has an $8 credit balance. Net bad debt expense is 3% of my net sales. First off, we want to estimate the amount that I think I'm not going to collect. 3% of net sales. Well, what is the amount of the net sales in this problem? Total sales were $1,000 minus the returns and allowances. Good. Gives me $900 net sales. Times 3% says I need to record $27 bad debt expense. So my adjusting entry would be a debit to what new account? Bad debt expense for $27 and a credit to what account? The allowance for doubtful accounts. I often refer to that simply as the allowance account. The allowance for doubtful accounts. Keep in mind, it's a contra asset. So when I credit that account, I'm making it go up. Debit bad debt expense to make the expense go up. Credit the allowance for doubtful accounts to make the contra asset go up. Notice, I told you the balance in the allowance for doubtful accounts was $8 to begin with. Did I use that anywhere here? No. So if I were you, I would go back up there to where you have the $8 figure given, and I would draw a line through it and write, I don't need this. Because it will be given to you in a problem, and you need to know to ignore it. I'm putting $27 into the allowance account to cover uncollectible accounts resulting from this year's sales. The $8 in the allowance account is to cover uncollectible accounts resulting from a previous year's sales. So we ignored the $8 balance in the allowance for doubtful accounts. What if the balance in the allowance account had been an $8 debit instead of credit? We'll talk about later on how that could happen. For what amount would I make my adjusting entry? Did that $8 have anything to do with my amount? No. We'd still make it for $27 then, because the $8 had nothing to do with the amount. I did not use that in my calculation at all. So we're going to completely disregard what is already in the allowance for doubtful accounts. We don't care about it. Basing it upon a percent of my net sales gives me the best matching on my income statement. Why is that? Well, my bad debt expense is a direct result of the amount of my net sales. This method is sometimes called the income statement approach because it focuses on giving us a good bad debt expense to go on the income statement. The second method is based upon something called aging my accounts receivable. Tell me this, if I ended up at the end of this year with twice as much balance in accounts receivable as I did last year, wouldn't you expect my bad debt expense probably to double? I mean, doesn't that seem reasonable? So the more receivables you have, the more uncollectible accounts you're going to have. We're going to look at my year-end balance in accounts receivable and try to estimate how much of that year-end balance I'm not going to be able to collect. To do so, we're going to categorize my receivables by how past due they are. And then we're going to multiply each group of receivables by a percent that I think I can't collect. Tell me this, what if I had only two receivables? This one's 30 days past due. This was 90 days past due. 30, 90. Which one am I less likely to collect, do you think? The older that receivable gets, the greater the likelihood I'm never going to get that money. So we're going to have a different percent uncollectible for each category of my receivables. When we do, we're going to multiply those out, we're going to add them up. We're going to get a total, but the important part is that's not what I'm going to make my entry for. Instead, the amount I calculate becomes my goal or my target, so that when I finish making the adjusting entry, that's what I want to have in the allowance for doubtful accounts. So I am going to have to make a journal entry to get my allowance account from where it is right now up to where it needs to be. Now, to do so will require that I think about what's already in the allowance for doubtful accounts. I have an example here. It's not on your handout, just look up here, please. We have a $60 credit balance in the allowance for doubtful accounts. We determined, based upon analyzing my receivables, that I should have $100 in that account. To get from a $60 credit balance up to a $100 credit balance, I would have to make my adjusting entry for how much? 40. In other words, you had to subtract, right? Let's do another example. The allowance for doubtful accounts had a $60 debit balance. We'll talk next class about how that could happen. It's not a good thing, but it could happen. Again, we want to end up with a $100 credit. To get from a $60 debit balance up to a $100 credit balance, I would have to make this adjusting entry for how much? 160. In other words, I would add debit bad debt expense, credit the allowance for doubtful accounts. So do you see why I had to think about what's already in that account to determine how much to make the entry for? Page 9 of the handout. Today is December 31st, 2013. The allowance for doubtful account has a $120 credit balance. We are going to categorize my receivables as not past due, 1 to 30 days past due, 31 to 60 days past due, and more than 60 days past due. Keep in mind, today's December 31st now. Lilith owes me $1,000. It was due on November 18th. Today is December 31st. Which of those categories would that receivable go in? 31 to 60. Why is that? Well, it is like, what, a month and 12 days past due? So 31 to 60 days. Norm owes me $2,000. It's due on December 26th. Today is December 31st. What category would it go in? 1 to 30, because it's, what, 5 days past due? Sam owes me $3,700. It's due on January 3rd of next year. What category would it go in? Not past due, and that's also called current. Not past due and current. Woody owes me $1,500, due on August 31st. It is December 31st. What category would it go in? More than 60. Finally, Lilith owes me $1,300, due on January 12th next year. What category does it go in? Not past due or current. The next thing we want to do is to add up the amounts in each category. In the not past due category, I believe we had two, didn't we? $3,700 and $1,300. So I have a total then of $5,000 that is not past due. 1 to 30 days, I believe I just had one in that category. Agreed? $2,000. 31 to 60 days, just one, $1,000. And more than 60 days, again, I just had one, or $1,500. I right now have customers who owe me $9,500. I need to estimate how much of that $9,500 I'm not going to collect. In the first group, $5,000, I think I'm not going to collect 2% of that. Now, I'm just making up these percents, quite honestly. Do notice what's happening to the percent as the age of the receivable goes up. What's happening to the percent that I made up? It's going up also. This would be the hard part in real life, is coming up with these percents. You'd have to look at what it's been in the prior years and then adjust it up or down for what you think the economy is doing right now. The $5,000, I think I'm not going to get 2% of that. How much of the $5,000 do you think I won't collect? $100? We're just going to multiply. 7% of the $2,000 I think I'm not going to collect. So in total, I think I won't get 140. 11% of the 1,000. How much do you think I won't get out of that group? 110. And finally, I think, half of that last group I'm not going to get, or 750. Now again, I made up those percents. For your purposes, they'll be given in the textbook, but that's kind of the challenge in the real world, is coming up with those percents. Stop and add them up, and we get $1,100. The question in your handout says, what is the desired ending balance in the allowance for doubtful account? Your answer is $1,100. That does not mean we make our journal entries for $1,100. That means when I finish this journal entry, I better have $1,100 in the allowance for doubtful account. We got to think about what's already in that account. Draw a T account. We already have a credit balance of $120 that was given to you. We said we want to end up with a credit balance then of $1,100. To get from a credit of $120 up to a credit of $1,100, how much must I make my adjusting entry for? $980. In other words, you had to subtract. To get from a credit of $120 to a credit of $1,100, you would have to subtract, make the entry for $980. Let's make the adjusting entry. What account do I debit in this new adjusting entry? Bad debt expense is my debit. And what account do I credit? The allowance for doubtful accounts. Very good. Debit bad debt expense, credit the allowance for doubtful accounts, and notice the entry is for $980. It is not for $1,100. It is for $980. What is the balance in the allowance for doubtful accounts after this entry? $1,100. That's what we were trying to get it up to. So I had to think about what's already in the allowance for doubtful accounts. Let's do one more example. Everything the same except for the beginning balance in the allowance for doubtful accounts was a $120 debit. And I'll have to wait till next class to tell you how that could happen, but a $120 debit. Again, you want to end up with $1,100 credit. I have a $120 debit balance. I still need to end up with a credit of $1,100. To get from a $120 debit to an $1,100 credit, I would have to make my journal entry for how much? $1,220. In other words, you have to add. So I would debit what account? Bad debt expense, good. And I would credit what account? Allowance for doubtful accounts. But this time it would be for $1,220. So notice my entry is not for $1,100. What would be the balance in the allowance for doubtful accounts after I post this entry? $1,100. The entry is for whatever it takes to get the allowance account up to $1,100. So I have to think about what's already in that account. This gives me the best number for the net realizable value on the balance sheet because I focus on getting a good balance in the allowance for doubtful account. Hence it's called the balance sheet approach as opposed to the other method which focuses on best matching on the income statement. So let's compare these methods. Is one good and one bad? No, they both are good. They both comply with GAAP. They're both a perfectly acceptable method. Basing it upon a percentage of sales gives me the best matching of revenues and expenses to go on the income statement. Basing it upon aging my accounts receivable gives me the best net realizable value to go on the balance sheet. One method gives me a good income statement, the other gives me a good balance sheet. And the key, I've said this a couple of times, if you're basing it upon a percent of sales, just completely ignore what you already have in the allowance for doubtful accounts. Completely ignore it. If you're basing it upon aging, you do have to take into consideration what is already in the allowance for doubtful accounts. Let's move now and talk about writing off an uncollectible account. Now this situation is we have a particular customer who will not pay us. We have done everything we can to get our money. He is not going to pay us. We need to write that account then off of our books, get that receivable off of my books. My journal entry, well, I think the easy part of this is my credit. What account am I trying to get off of my books? Accounts receivable. So we're going to credit accounts receivable to make the asset go down. If you hadn't looked at your notes and you had just thought, what account do you think I ought to debit to write off an account as uncollectible? What just seems like the logical first thing that pops into your mind? A bad debt expense? Bad debt expense is normally what students think, and I'd probably do the same if I didn't think about it too much. So it seems logical we debit bad debt expense, but we don't. Instead, we're going to debit the allowance for doubtful accounts. Well, quick review. What type of an account is the allowance for doubtful accounts? Contra asset. Very good. So a contra asset goes up with a credit. When I debit that account, I'm making it go down. Why did we not debit bad debt expense? Well, I want you to look back at where we made the adjusting entry. I think one amount was $980 and the other was $1,220, if I remember correctly. And tell me, what account do I debit in that adjusting entry? Bad debt expense. Okay. Was that for an absolute known factual amount or for an estimated amount? It was an estimated amount. So we've already debited that account once for an estimated amount. Would we want to come back and debit it again when we actually know what the write-offs are? Well, that'd be counting it twice. We didn't like it the first time to begin with, did we? So we certainly wouldn't want to count it twice. Instead, let me try to explain to you the way I think of the allowance for doubtful accounts. Anybody got an old car? What's the good thing about having an old car? You don't have a car payment. What's the bad thing about having an old car? Repairs. So we don't have the car payment anymore, but do we have the repairs? Yeah. It's not a matter of if it's going to break. It's a matter of when it's going to break and what's going to break on it. Now, if we were smart, when we finished paying off that car, we would take maybe not the whole amount of that car payment, but we'd take part of it each month and put it aside in a little savings account, wouldn't we? Wouldn't that be the smart thing to do? Put it aside so that when my car breaks, it doesn't devastate me financially that month when you get that huge bill. I could just go pull that money out of that account that you've set aside, right? Kind of a little reserve fund you've created because you know your car is going to break. Well, that's kind of a way to think of the allowance for doubtful accounts. You know some people aren't going to pay you. You don't know who, you don't know how much, but you know it's inevitable some people aren't going to pay you. So in that adjusting entry, you're putting some money aside in the allowance for doubtful accounts. Then when a customer actually doesn't pay you, it doesn't hurt you this period. You just go pull it out of that reserve account. Now, truly, we don't transfer money around. It's not dollars changing hands like that. But that's the concept, the way I like to think of it. It's kind of like a little reserve fund. You put some money aside each period. When you need it, you come grab it out of that account instead. So my entry to write off an account as uncollectible debits the allowance for doubtful accounts to make that contra asset go down and credits accounts receivable. Now, we said previously that the allowance for doubtful accounts is a contra asset. And the balance in a contra asset should be what? Debit or credit? It should be a credit. But then I said sometimes temporarily we might end up with a debit balance in that account. I said we'll talk later on about how that could happen. Well, let's talk about that now. I want you to look back at that adjusting entry. Again, we did last class. It was $1,220 or $980, either one. And tell me, what did we do to the allowance for doubtful accounts in that adjusting entry? Did we debit or credit that account? We credited that account. Was that for an absolute known factual amount or was it for an estimated amount? Estimated. So we credit the allowance for doubtful accounts for an estimated amount. Now, I just told you to write off an account as uncollectible. What do we do to the allowance for doubtful accounts? Debit it. Is that for an absolute known factual amount or is it for an estimate? It's known. It's an absolute known factual amount. So my allowance for doubtful accounts, what you just told me, is that we debit that account for my actual write-offs. We credit that account for my estimated write-offs. Well, just by comparing those figures right there, can you tell me how we could temporarily end up with a debit balance in the allowance for doubtful accounts? The actual write-offs were more than what we expected. We expected 100, we actually wrote off 150. That could end up with a debit balance in that account. Is that a good thing? No. We would never leave that account with a debit balance at the end of the period. We'd always make the adjusting entry to get it back to a credit balance. But temporarily during the period, we could end up with a debit balance in that account if we didn't estimate enough. Writing off an account is uncollectible. What effect does that journal entry have on bad debt expense? Trick question. Didn't affect bad debt expense, did it? That's kind of counterintuitive, what we might not expect, but it doesn't affect bad debt expense. What effect would you think writing off an account as uncollectible would have on the net realizable value of your accounts receivable? Wouldn't it seem logical that it would go down? When you write off an account you can't collect, wouldn't you think your net realizable value of your receivables would go down? Let's review quickly. What is net realizable value? It is your total accounts receivable minus what's in the allowance for doubtful accounts. Well, actually, It doesn't impact your net realizable value at all. Let's do an example so we can see how that is the case. Sam owes me $10. He will not pay me. I cannot get that money out of him. He will not pay me. Make the journal entry, the one we just discussed, to write off Sam's account as uncollectible. Jot down the debit and the credit to write off his account as uncollectible. What account do we debit? The allowance for doubtful accounts. Good. The contra asset. What account do we credit? Accounts receivable. My net realizable value before I made the entry. Well, my total accounts receivable was $200. I subtract the $30 allowance for doubtful accounts. I get a net realizable value of $170. Now let's stop right there for a minute and make sure we understand those numbers. People owe me a total of $200. I think I'm not going to collect $30, which means I think I am going to collect $170. We just wrote off Sam's account as uncollectible. What effect did that have on my accounts receivable? Made it go down by 10, right? So the balance in accounts receivable now is $190. What effect did that journal entry have on my allowance for doubtful accounts? Made it go down also by 10, so it now has a balance of 20. My old net realizable value was 200 minus 30 is 170. My new net realizable value is 190 minus 20, again is 170. It does not change. So writing off an account as uncollectible will not affect the net realizable value of my receivables. The biggest impact would come when we make that adjusting entry, debiting bad debt expense and crediting the allowance for doubtful accounts. That's going to impact my net realizable value. The next topic is the more cheerful one. We've written off an account as uncollectible, and now somebody whose account we wrote off previously, they turn around and pay us. It's a good day. They wouldn't pay us before, we wrote them off as uncollectible, now they turn around and pay us. Someone turns around and pays us that we thought was not going to pay us. We call that the recovery of an account that I had previously written off. To record that takes not one but two journal entries. The first one puts the receivable back on my books, because remember, I just took it off, it puts it back on the books. The second one records a customer paying me on account, just like any time a customer pays me on account. So my first entry is a debit to accounts receivable and a credit to the allowance for doubtful accounts. Now do me a favor, I want you to flip back to the entry we just made for $10 to write off Sam's account as uncollectible, and tell me how that entry compares to the entry we made to write off Sam's account. Exactly the opposite. The second entry debits cash and credits accounts receivable. Now does that second entry look pretty familiar? We've been doing that since chapter 2, haven't we? Anytime a customer paid me on account, I debited cash and credited accounts receivable. Now, look at what I have on the screen there with those entries, and can you tell me something that honestly just looks kind of stupid? I debit accounts receivable, then I credit it. That seems kind of silly. Doesn't it seem like I could instead just debit cash and credit the allowance for doubtful accounts? Well, the reason we do that takes us back to something I talked about last class, and that is the fact that certain accounts we need to keep a subsidiary ledger for. A subsidiary ledger gives me more detailed information about some account in the general ledger, and accounts receivable is one of those I need. I need to know not only in total how much my customers owe me, but I need to know customer by customer how much people owe me. The reason I'm going to do this is I'm going to have to post that debit and credit to accounts receivable, not only to the general ledger, but also to Sam's page in the general ledger, if he's my customer. And therefore, when I come back in the future and look, I'll have a record on Sam's page showing the fact that, oh, he did turn back around and pay me after all. If I had not made that entry to Sam's page, I would not know that. So the whole reason of doing that is to post the entry to the subsidiary ledger for accounts receivable.